All right, so thank you so much for joining us on this webinar. We are very excited that you guys have decided to join us. This is actually the largest number of people that have decided to be a part of a webinar like this. Eventide, which is a mutual fund company that we really like, has done a couple of these for some other independent advisors throughout the country, and this one so far has been the most attended. So we're excited about that. We know that so many of you guys have questions about the market, especially during this kind of volatile time. Having gone through some of these slides before this event, we know that this is going to answer a lot of your questions, and we're excited about that. So as an introduction, Eventide is the mutual fund company that actually helped us put together that COVID-19 video that so many of you watched. I think it got several thousand views when we posted it on YouTube. We love their approach to investing, and we're excited to have you guys listen to some of their wisdom. Jason is going to be the one that's going to be going through some of these slides and sharing some of the information. But the other co-founders of Stewardship Financial, the advisors that you guys know and love, Jake and Jeremy, are both on this call. And after this is done, we are going to answer some of your questions in a Q&A session. We'll give some instructions on how to do that, but you're not going to have to get on video. Don't worry about it. All you're going to have to do is type in your questions, and at the end, we will do our best to answer each of those. So again, we're excited to have you. Jason, thank you so much for being willing to do this. Take it away.
Yeah, my pleasure. It's so good to be with all of you, and especially with such a large group. I'm very excited to get to spend my afternoon with you. So this presentation we're titling Timeless Truths for Investing. A little bit more about me, just so you know who you're listening to. My name is Jason Myhre, and I'm a managing partner of Eventide. We're a mutual fund company that's headquartered in Boston, Massachusetts. We practice a values-based approach to investing. My day-to-day work is in an area we call advocacy, where I advocate for the application of your values to investment decision-making. I do that for all kinds of audiences. With that, let's formally begin. Okay, so just to set the stage here, as we speak, we know what's going on. The US is the epicenter of this virus worldwide, with an exponential ramp in the growth of new cases. It's a very scary time for all of us. We're all cloistered away in our homes. In many ways, we've seen the economy grind to a halt in many industries, and this has roiled the stock market. The stock market has experienced, believe it or not, the fastest decline in the history of investing. And then a couple of weeks ago, it experienced the fastest gain since the 1930s. And with this roller coaster ride that we're in, and given so much uncertainty surrounding this pandemic, question is, how should we think about investing? What do we do about our investments, if anything? How do we situate our concerns with the market? And I think now is the time for us to be reminded of what has been timelessly true for investing. And I have 5 points that I'll put up at the beginning, and then we'll walk through each one. The first is, keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe, and invest in businesses, not stocks. We'll kick it off with keep your eye on the owner, not the dog. What do I mean by this phrase? It comes from perhaps my favorite quote on investing from a person named Ralph Wenger, whose picture is shown here. He's a legend in the investment industry. He was the portfolio manager for the Acorn Fund, which had a very successful track record. And he once explained how markets work, as recalled by someone named Bill Bernstein in one of his books on investing. Quote goes, he likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. At any one moment, there is no predicting which way the pooch will lurch. But in the long run, you know he's heading northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not the owner. I want to show you where he gets this mental picture from. This is the complete history of stock investing in the US. Just to give you the lay of the land here, I'm going to point out a couple of things. So the S&P 500 began in 1926, which is this point on the map. But the US stock market began back in 1871. And we actually have daily records of all the stock prices. And so what we've done is reconstruct the history of the market using those stock prices and applying the S&P 500 methodology. And then we're performing two important transformations on the data. Number one, we're adjusting it for inflation throughout this history so that we get a sense for the real result of the market. And number two, we're reinvesting the dividends from the companies in the market, which is an important source of return. So we're getting a total return, real perspective on the entire history of the stock market. This is 149 years. And look at this result. It has been a remarkably predictable experience. The blue line shows the vagaries in the market, the ups and downs that are typified by that dog on that very long leash in New York City. The owner is represented here as the best fit line, this yellow line, which goes throughout the entire history of the market. And this is a straight line. There's absolutely no curvature to it. What a remarkable fit this straight line has for the history of the market. It has been, for 149 years, up and to the right. It has been a constant rate of growth of 6.6%. This has been referred to as the growth constant, or the Siegel's constant, named after a person named Jeremy Siegel from the Wharton School of Business. And our task as investors in times of market turbulence is to take a step back and remember the big picture and to pay attention to the owner, represented by the yellow line, and not the dog, represented by the blue line. Just wanted to point out that our current crisis is shown on the map here. I've taken it up as close as I could to the present day, and you can see so far we're just a blip on this historical map. And I think that we can gain comfort from this 149-year remarkably predictable history. All right, point number two, restrain yourself. What do I mean by this? I want to kick this off by looking at a historical example. So this is from the Wall Street Journal. You can see the date of the publication is December 31st, 2009. Every decade, there is crowned a new king of mutual funds based on their 10-year performance number. This is at the close of the 2000s, and the best stock mutual fund for the decade was a fund called the CGM Focus Fund. You can see here, meet the decade's best performing US diversified stock mutual fund, Ken Huebner's $3.7 billion CGM Focus Fund, which rose more than 18% annually, meaning per year over that 10-year history, and outpaced its closest rival by more than 3 percentage points. Just a word on this time period. So we're talking about the 2000s, from January 1, 2000 until December 31st of 2009. It was a terrible decade for investing. Some have called it the worst period of performance, market performance in history. It's been termed the lost decade because you invested for 10 years and you would have got a result of negative 24%. And here, Ken Huebner achieved a per year performance of positive 18%. So just killed it, right? And so very, very impressive result. Just a personal anecdote here. Ken Huebner works in the same building that I do. And so I've gotten to ride the elevator with him on at least one occasion that I recall. So what I want to do is I want to ask a question. I'm actually going to launch a poll here for you to interact with me. And I'm going to let our panelists join us in this poll. So the question is this: what do you think the average investor in this mutual fund experienced as a return on a per year basis? So the fund achieved 18% per year. What did the average investor in that fund achieve per year? And we'll get to see some of the results here. Great, thanks so much for participating. Give you Another moment here. Okay. So our answers in. So 8% of you said that the investors returned 18%. 12% of you said that investors received 12% per year. 32% said 9% per year, and 36% of you said 2% per year, and then 12% of you said negative 11% per year. So I'll show you here's the results. Hopefully you all can see what I'm showing you on the screen right now. And so just take a look at what everybody said. The dominant answer was 2%. The way in which I've asked the question leads you to believe it was less than 18%. I want to show you, share with you now the actual results. So the article continues. Too bad investors weren't around to enjoy much of those gains. The typical CGM-focused shareholder lost 11% annually over those 10 years, according to Morningstar Inc. So the fund is up 18% per year. The average investor in that very same mutual fund was down 11% per year, and underperformance in their own investment of 29%. Now, how in the world is this possible? Many of you may have already guessed this. These investor returns, this is from the same article, are known as dollar-weighted returns. They incorporate the effect of cash flowing in and out of the fund as, and the key here is, shareholders buy and sell. Investor returns can be lower than mutual fund total returns because shareholders often buy a fund after it's had a strong run and sell it as it hits the bottom. And so what happens is people go shopping for a mutual fund. They find this fund has an excellent track record and they say, wow, look at the performance on this fund. And so they buy it, and they buy it at a top. And then the fund begins to decline, as every investment is prone to do. And they say, man, this fund is a dog, I'm out of here. And so they redeem their investment, often at the bottom. And then lo and behold, the investment makes a return in performance. People pile in at the top, they ride it to the bottom, and then they cash out. They make all of the classic investor behavior mistakes. This is a quote that I think is probably the top one. This is a top 3 quote that people like to say about investing. It comes from Warren Buffett, who says, be fearful when others are greedy and greedy when others are fearful. The meaning of this quote is that when everyone is panicking, the subsequent or following returns of the market have been above average. And so you actually should be greedy at that time. And when everyone's feeling great and is euphoric and is greedy, that typically marks a market top, and the subsequent returns of the market have been poor. And so that's actually a time when we need to be fearful. Now, everyone loves to quote this sage wisdom from Warren Buffett, and it is timelessly true, but very, very few are disciplined enough to practice it. And it's very easy for us to point the finger at the CGM-focused shareholders and say, oh, those fools, if I had been them, I would have stayed through it because I know better. But the reality is that we all make these classic mistakes. And I want to turn the mirror to ourselves here. This is a book written on psychology, written by Daniel Kahneman, who's a Nobel laureate in economics. It's called Thinking, Fast and Slow. This is a book that's been quite popular, at least in my circle. It's gotten passed around. And this is from page 1 of the book. The premise of this book is that it's easier to recognize other people's mistakes than your own. We so easily see these behaviors of investors like the CGM Focus Fund and think that we are different. And so as we look in the mirror, I just want to show you that we are our own worst enemy. And this is something that is timelessly true. This is looking at 20-year annualized returns on various asset classes from the years 1996 through 2015. So these are annualized returns, meaning per year returns. The best investment you could have made during that time period was real estate investment trusts, things like investing in office complexes. You would have gotten 10.9% per year. You can see the S&P 500, 8.2, a 60-40 blend of stocks and bonds, a 40-60 blend of stocks and bonds, bonds themselves, gold. This is international stocks, homes. So this is the value of our own homes, rising and falling. Oil. This was the rate of inflation. And then look at this, the average investor. The average investor underperformed every single possible investment that they could have made in this 20-year time period. We are our own worst enemy. And why is this? For the exact same reason that we saw with the CGM Focus Fund shareholders, we tend to pile in at the top, ride it to the bottom, and cash out when we become fearful. We have to restrain ourselves from making these classic errors. I love this quote from Morgan Housel, who says, finance would be better if it was taught by the psychology and history departments at universities. I showed you the history with the dog and the owner, and we just looked at the psychology, that those cognitive biases that we all have that cause us to panic and to cash out at the worst possible times. Here's another quote from a legendary investor way back in time, a person named Jesse Livermore, who says, the big money is not in the buying or the selling, but in the sitting. We can't get cute and try to dance in and out of the market and time the market. It is a fool's errand. And the big money in investing is in the sitting and restraining ourselves. Point number 3, employ a system that forces you to buy low. Okay, so when is the best time to invest? We all know this, when prices are low. And so I want to talk about how we can employ a system here that will force us to buy low. And to do this, I want to introduce an experiment to you. So let's suppose that you were dropped into history anywhere between the year 1920 and the year 1979. So let's say you got airdropped into 1935 or 47 or 53, etc. Anywhere between 1920 and 1979. And you have to invest in the US stock market for the next 40 years. You have a choice of strategy. Option 1, you can invest $100 a month. Option 2, you can save up that $100 a month, keeping cash on the sidelines, and then try to buy the dips in the market. That is the times when the market is at a low between two relative highs, when the markets crash. So right now it's a perfect example. But with this option, I'm going to sweeten the deal. I'm also going to grant you perfect knowledge about the future so that you will always be guaranteed to buy the dips on their absolute bottoms. And the question is, which would you choose? And we're going to launch another poll here, and I want to see what you would say. All right, answer now. So again, option 1 is invest $100 a month. Option 2 is to save up that $100 a month and to try to buy the dips in the market. So deploying that cash when markets crash. What do you think? Okay, I might have set this poll up incorrectly because I haven't gotten any responses yet. So I'm gonna go ahead and kill it, and we're gonna go from here. All right. So which would you choose? At least you've made that decision in your own mind. I suspect that based on the way that I've presented you the options here, option 1 is so preposterous that many of you are playing the contrarian and saying, oh, I'd take option 1. But I'm telling you that the vast majority of people would feel like option 2 is a slam dunk. This seems like a no-brainer. And it's not exactly a slam dunk. So what I want to do is I want to show you that somebody actually performed this experiment. They looked at every possible 40-year time period. So if you'd been dropped into history in the 20s, and then the subsequent 40 years, they tried both strategies out, and so on. For every possible 40-year period, they looked at both. And what this chart is showing is the results. So above the dotted line here, you can see this is the period of time that the buy the dip strategy outperforms, or in other words, the time that option 2 outperforms. Below the dotted line is the time that buy the dip underperforms, or said another way, you should have chosen option 1. So you can see that in the 1920s up until the early 30s, the buy the dip strategy was in fact the superior strategy, option 2. And then you can see again, there was a period of time in the late 30s, early 40s when that would have been a superior strategy. But look at the amount of time that that boring monthly investment of $100 outperforms. It is in fact 70% of the time that this boring strategy of investing $100 a month was a superior strategy, 70% of the time. And if we were to take away that perfect knowledge of the future, which of course none of us have, have we already experienced our market bottom for coronavirus? We don't know, right? And if we were to mistime those buying the dip, mistime the buying the dips by just 2 months, which is easy to do, then monthly investment, the boring strategy, outperforms 97% of the time. Crazy, right? So how can this be? I want to show this to you. What is this magic? It's called dollar cost averaging. Maybe you've heard about it. It's super boring, but it's super important. Okay, so here's what it means. It's very simple. It means investing a fixed amount of money at regular intervals over time. Perfect example is our $100 a month. And I'll show you why this works, but here's the text explanation. When we invest a fixed amount of money, this strategy will naturally do two things. Number one, it will naturally buy more shares of an investment when prices are low. So fixed amount of money, that money goes farther when prices are cheap. And it will naturally buy less shares when prices are high. Fixed amount of money, prices are expensive, our money doesn't go as far. I want to show this to you using a real example. We're going to go back to that lost decade in investing, that period of the 2000s. You can see there were 2 market crashes during that time, such that if you invested on day one and held through the period, you would have been down 24%. Now let's look at what happens with a dollar cost averaging strategy. So same chart that I just showed you is at the top. On the bottom, the blue line represents what happens when we invest a fixed amount of money over this period in the market. And so you can see the market started off at a relative high, and so a fixed amount of money didn't go as far. You were only able to purchase 3.5 shares in this example. But as the market begins to crash, our dollars go farther, and we're able to accumulate more shares. You can see then the markets rise out of this bottom, so our money doesn't go as far. It crashes again, and we're able to accumulate more shares. Notice, if you just kind of take a step back and look at this chart, notice how the dollar cost averaging strategy is also a buy the dips strategy. Do you notice how it peaks when the markets are at their absolute bottoms? It's especially poignant at this point right here. And so this is a buy the dips strategy in disguise, which is one of the reasons why it's so powerful, because none of us know when these market crashes are going to happen. And this strategy allows us to capture them. Dollar cost averaging, in fact, purchases nearly twice as many shares when prices are low. You can see 3.5 shares up to 6.5. That's nearly 2x. And what's more, if you had plugged away at a fixed amount of investment over this 10-year period, you would not have been down 24%. You would have been up 5.9%. So not great, but certainly better than a loss of 24%. But there is another reason why this is a superior strategy to buy the dips. And it's going to be illustrated using this survey. But before I introduce it to you, I actually want to try one more time on a poll. This is my third and final poll here. We'll see if it works this time. Thank you for bearing with me in this experiment. All right, so let's try this one. So what I want you to do is I want you to recall the stock market from last year, okay? And no cheating, no looking up online. I want to ask you this question. As far as you know, how did the US stock market perform last year? Did it increase in value, stay about the same, or decrease in value? And if it was up, how much was it up? So everyone weigh in and we'll see what you say. We'll see how savvy you guys are on your knowledge of the markets. This is great. This one's working, so I really appreciate you guys bearing with me on my failed second attempt. I'll leave the poll open here just a moment longer. So again, the question is, how did stocks perform last year? It's in the history books. Were they flat? Were they down? Were they up? And if they were up, how much? Okay, I think we've got a good consensus here. I'm going to end the polling and show you the results. 1 second while it calculates. Okay, so here were the results. You can see 5% weren't sure, 8% thought that stocks stayed about the same. Some believe they increased, not sure how much. Some thought they were up 10%. The majority answer said 20%, and some believed it was up 30%, and 3% thought 40%. Okay, so we got the results here. In fact, the right answer was that the market was up about 33%. So let's see, 14% of you got that correct. And so you're actually better than the average audience. So well done, Stewardship advisors, on teaching your folks well. But you still, the majority of you still didn't get it right. And this has been a classic survey that's been repeated. Exact same survey that I showed you. This is conducted by Gallup. You can see the date here is 2014. They're asking people the exact same question I asked you about 2013, so the prior year. And you can see that the market was up a little more than 30%. You can see that only 7% of the average US population correctly knew that stocks were up. So the majority of people, you can see, were just unaware of how markets were doing. And this has been repeated time and time again. And the net result is that most people are acutely aware when markets crash, but not aware when the market is making gains, which, as I showed you on the dog and the owner, is most of the time. And so the reason that the dollar cost averaging, the boring amount of money every single month of stocks is a superior strategy, because it gets you in the market. Here's a quote: "While you wait for the next step, the market is likely to keep rising and leave you behind." And that is keeping our eye on the owner. So the buy the dip strategy, or excuse me, the dollar cost averaging strategy helps you to buy those market lows in a smart way, while keeping you in the market to experience the market's long-term gains. This is a quote from an unlikely person. This is Napoleon Bonaparte. This was his definition of military genius. He said it was the man who can do the average thing when all those around him are going crazy. Do the average thing. You are not going to impress your friends. They're going to think that you are unsophisticated, not savvy. They're going to be listening to some podcast on investing and think that they've got the latest and greatest strategy to outperform. And 97% of the time, you will do better than them. All right, number 4, remember the most powerful force in the universe. Believe it or not, Albert Einstein once made this remarkable quote: "The most powerful force in the universe is compound interest." Think about this person's contribution to science, and he is most impressed with compounding interest. What a boring thing, right? Well, I want to show you why he's so impressed. All right, we're going to look at this using a humble example. We're going to talk about investing instead of buying a cup of coffee. So if you, instead of spending $3 a day on coffee, which is the US average, if you invested that, after 40 years, how much would you have? If we assume that the Siegel's constant, that historic growth rate of 6.6% that I showed you at the outset of this presentation, we'd have more than $210,000 after 40 years. So modest, but hey, you only socked away $3 a day. So this is a very expensive cup of coffee, and I think can help us to think about putting our money to work and investing. So what is compound interest? I'm going to give you a definition here, but as I looked at definitions of this, they tend to be very technical and wonky. I actually like this much simpler definition from Benjamin Franklin, who defines it this way, and I'll explain what the quote means after I read it. He says, "Money makes money, and the money that makes money makes money." Okay, so that seems opaque. I'm going to explain it. We're going to look at the math on our coffee example. So $3 a day is, if you multiply that times 365 days in the year, you get $1,095. That's how much you're investing. You're putting that investment to work at a growth rate of 6.6%, the annual rate of growth for stocks. And so at the end of year 1, you've got $1,167.27. Year 2 is when the magic of compound interest begins to start. So you invest another $1,095. You add that to what you had already, which was, it's already grown a little bit. And so that total is $2,162.27. Now this amount grows by 6.6%, and you get $2,411.58. This continues to go. And I'll show you on the next chart, but it begins to snowball. So it starts out very modest. And if we look at Benjamin Franklin's definition here, so your money, that $1,095, makes money because of the 6.6% growth. And then the money that made money makes money. So it grows itself. The interest grows along with all of the principal investments that you're making. And as I said, this begins to snowball. Here's our cup of coffee over time. So you can see that what we're investing is a straight line. After 40 years, we would have invested $43,800. But because of the power of compound interest, it's grown to $210,000. If we look at a more realistic example, if just maxing out our IRA, $6,000 a year, which most of us can find from pinching pennies, we would have invested $240,000 over 40 years, and that would have grown to more than 1.1 million. And this is very sensitive to the growth rate that we were to apply. If we were to assume a higher growth rate, the numbers begin to look much more impressive. But notice that this is an upward sloping function. The longer this goes, the steeper it gets. It is an asymptotic function, as they say. And so this is why people why advisors encourage their clients to start early, right? The earlier we start, the more the magic of compound interest begins to work for us. Going back to Benjamin Franklin, when he passed away, he gave a gift of $5,000 to Boston and a gift of $5,000 to Philadelphia. And he said, you can't touch it for 200 years, and it had to be invested. After those 200 years, it turned into tens of millions of dollars. It's from 5,000 to tens of millions of dollars. And the cities of Boston and Philadelphia are still reaping the benefits from that very humble contribution, and it's because of the power of compound interest. It's because time is on my side. Yes, it is. This is famous investors, the Rolling Stones, and some of you know. And then another quote from the legend Warren Buffett, who says, the stock market is a device for transferring money from the impatient to the patient. Just trust that time is on your side and put your money to work. Okay, final point here, and actually I think this is the most significant. Invest in businesses, not stocks. What do I mean here? Okay, so one of the convictions I have at my company is that we as a people have by and large completely lost sight of what investing is all about, what the true purpose of investing is. Investing has been really divorced from its original and most basic purpose, which is to invest in businesses, to supply capital to businesses for their use, to partner with those companies that we believe in, and to grow with them over time. What's happened is that many people are trying to profit from the market itself, almost like an abstract money-making mechanism, rather than from any of the productive and intrinsic value of individual businesses that are a part of this market. We tend to think that we are participating in the market rather than businesses, and we are not so interested in individual businesses, but rather in simply techniques for extracting money from the market as a mechanism. Well, what happens when we do this? When we lose sight of this ownership perspective, what are we left with? We're left with a relationship that lives and dies on the basis of performance. And so this relationship is going to be tumultuous. It's going to go up and down as the markets go up and down. And as a result, we will lose our confidence at times like these. And so I think it's really important to recover this historic perspective. This is a person at DePaul University, a professor, who talks about what it's like to be an investor. He says retirement accounts tend to go into mutual funds, whereas an investor, not only do I not have any idea how the companies that I have stock in are being operated, I don't even know what companies I have stock in. And they're run by an elite of managers whose one preoccupation is with profit, with increasing the bottom line. Have you ever felt this way? Have you ever wondered what is funding your retirement, what companies you're involved in, and if you feel good about the sources of those returns? This is a famous hedge fund manager named Cliff Asness. I heard him say this quote at an investor conference a number of years ago, where he said, I pride myself on not knowing what's in our portfolios. So this is an investment manager choosing companies on behalf of his investors, saying that he considers it a point of pride to not even know the names of the companies that he's choosing for his investors. He's driven by the numbers only. He's a quantitative guy, and everybody thinks this is just cool rationality. I remember looking around the room at this conference and seeing how people took this statement that he made, and you could see awe and admiration on their faces. People celebrate this, but I actually think that it is something to lament. We have to remember that investing is company ownership. Supply capital to a business. This is what gives us the rights to profits and growth. It also entangles us in whatever that business is doing. We will be receiving profits from whatever that company is doing, and this can be good or bad. And so since it's ownership, we should ask ownership questions. So as we're connected to companies, we should have questions about management teams, and through management teams to their customers, employees, suppliers, communities, the environment, and society. I think at the heart of having peace of mind in investing is knowing what you're stepping into and believing in the businesses that you own. Here are some questions we could ask ourselves here. About leadership teams, we could say, hey, would we want to work there? Would we want to work under that leadership team? How likely would we be to recommend that product or service to a friend or a loved one? How would we feel if our children wanted to go work for this company? On a scale of 1 to 10, where 1's a new flavor of gum and 10 is a cure for cancer, how much value does this product bring to the world? If we were to walk into a supply center, would we be proud of the quality and working conditions? What would our reaction be if this company opened an office in our neighborhood, opened a supply center, plant, or factory? And does this company's environmental policy and actions leave a better planet for our grandchildren? You know, these are very basic questions, but I think they get to the heart of what we truly want out of our investments. I think if many of us were honest, we want to feel good about the sources of the return that we're receiving. And I think it's possible through this level of analysis that we do on your behalf. Last quote here, and I think this is, it's a long one, but would you please read it with me? I love it. This is from our Chief Investment Officer, Finney Curavella. He talks about how we can get peace of mind in investing, and I think this is the truest source for peace of mind. He says this: by investing with Eventide, you will grow in your peace of mind. How do we get peace of mind? Peace of mind is the byproduct of trust, and trust is the byproduct of knowledge. Many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents, trusts the management of that business, and so comes to believe in the company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge even stronger, making these declines attractive points to invest further. At Eventide, we help our investors understand the merits of our portfolio companies so they can better appreciate what they own and thus transcend a mere chart-based financial relationship. Eventide investors can then have greater confidence and less stress because they're not buying mere paper or a derivative, but a portfolio of quality businesses they know and trust. After all, life should not be spent staring at a computer screen watching ticker gyrations, but instead free from needless stress. At Eventide, we strive to help give you that peace so that you can spend your time on what matters most. All of us want peace of mind, and the way that we find it is by better understanding what we're stepping into and investing and believing in those businesses for the long term. We do a lot at my company to explain, to connect you with the businesses that you own. You can go on our website and read about these companies if you are interested. So what are the timeless truths? Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe, and invest in businesses, not stocks. With that, I'm going to open it back up to Jeremy, Jake, and Grant. Guys, if you want to come back on.
Jason, thank you so much for that presentation. That was awesome. It was simple. It was very easy to follow through with, and to be honest with you, a part of that was convicting, right? Before I kind of get into the close, I just want to let everybody know who's listening, there is a question and answer time now. You should be able to type in your questions at the Q&A at the bottom. Is that correct, Jason?
Yeah, so if you hover over the controls that you're looking through to view the screen, there's something called Q&A, and there's an open text field there. If you have any questions, you can type in a question there, and we'll see them on our side, and I can voice those to the audience and either field it myself or maybe pitch it to one of these guys to flex their acumen.
Yeah, and the thing that I really liked about this presentation, Jason, is that the best strategy is simple.
Yes.
And sometimes that simplicity doesn't always give us a point of pride or something to brag about to our friends and family members. I really like that. That was the part that was convicting, right? So many people want to be able to say they bought at the bottom, and as a result, they got this large return.
Yeah.
Really, our pride should be turned into not so much of a pride, but a way to inspire people by the heart behind our investing. And that is, we're not investing in a 401k. We're not investing in an IRA. Those are types of accounts. We're investing in real businesses.
That's right.
I mean, if we think about what's happening right now in coronavirus stuff, there are so many local businesses that we know the owners. And we know the owners of these coffee shops, these restaurants, these places that are hurting and they need help, right? So what we're doing is we're showing up and we're trying to buy gift cards and we're trying to get the word out that they still are open and you can go check them out. And why are we doing that? We're doing that because we want to support those businesses. We know that the dollars that we spend there now literally helps their endeavor. And that's the same mindset we need to have with our investing. When we put money into our 401k, our IRA, or any other non-qualified account, that is our money that's going to literally fund an endeavor of a particular business. And hopefully those businesses are doing good. Hopefully those businesses have amazing company cultures where they treat their employees right. Hopefully those businesses are doing some awesome things in the world. And we can say too, that we're helping with our investments make the world a better place. It's aligned with our values. And I absolutely love that. And I hope that everyone here listening now knows that, yes, the best way to ride out this volatile market is to do the simple thing, the dollar cost averaging. And maybe hopefully people listening now are convicted about their mindset about investing and knowing and understanding that these are real businesses that they're supporting, and they should get to know those businesses with their advisor as they're walking through this stuff. So thank you so much for that presentation.
So well said. So well said. I couldn't agree more. We do have a couple of questions that have come in. Here's an easy one that I'll take. Is Eventide similar to a mutual fund, but with concern for the companies that are invested in? Yes, it is a mutual fund. We're a mutual fund company. We have a number of mutual funds. Those of you that are clients of Stewardship, you are likely already invested in one of our funds or more. And yeah, we are a mutual fund. Our goal is to help you outperform the market. That's what we strive for, but we do that in a very intentional way by engaging in those questions that I asked you to try and discern businesses that we really believe in, that we would really be, we talk about it as companies we would be proud to own, companies that we're excited about for the long term, excited not only because of their potential for profit, but excited because we believe in what those businesses are doing in the world, and we get to participate in the blessing that comes through those businesses. All right, so here's one I'm going to pitch to one of you guys.
Jason, I want to stop real quick and give you guys a bigger plug than that. If I just go right to your website, it says, the header of your website says, investing that makes the world rejoice. Like, how beautiful is that, right? And under that, it says investments designed for performance and a better world. And that's why we partner with you guys. That's why we have many of our clients invested in some of your funds, because we too believe in that. And the heart of Stewardship is aligned with the heart of Eventide, which is also aligned with the heart of our customers. And we thank you for that. So
thanks. Yeah, appreciate the encouragement there. I want to pitch a question to you guys. So one person says, hey, this will be my first time investing. How do I get started, and how much do I start with?
Jeremy, you want to take that? This is kind of our typical answer right now, especially as it pertains to making sure we stick to the plan, right?
Yeah. So, I mean, being a first-time investor is great. You want to start investing as soon as possible, just because of the whole compound interest thing. And so when you start investing, a lot of times you're starting at zero. And so that is okay. At Stewardship, we have access to technology and things like that where you can invest with minimal amounts to start, and then just set up that dollar cost averaging plan going forward. So you don't even have to think about it. So yeah.
And the dollar amount is going to be told to you by figuring out your needs, your desires, your goals, and putting together an actual financial plan for you. So that dollar amount that you should start investing with is going to be different for you than it's going to be for everyone else. Personal finances should be personal. Jake, do you want to take Jason's question?
Yeah. So Jason, a different Jason, was asking, is now a good time to put a one-time lump sum of cash into the market in addition to the month-over-month money that I invest since the market is down? Even if the market is not at the bottom, it is down a lot from a couple months back. So yes, the way we've been telling our clients is, like, you don't have to do anything different. Like, if you're investing in regular intervals, keep doing what you're doing. But there are people who do have extra cash, and yes, I would say it is a great time. Just knowing in advance that you do not know when the bottom will happen. But Jason's point is, yes, the market is still down, so it's now a good time to invest more, for sure. If you're a long-term investor, it's a great time.
Yeah, I'll just chime in. So we just got a 401k plan. Well, we just updated our 401k plan at my own company. So I'm an employee, of a company, and we just have a 401k plan. I've been bad about getting started, and it's like they say, the landscaper's yard looks the worst, and so but I actually now I'm almost happy to get started, and so I'm actually doing that this week, and for the next couple of months I'm going to do just 100% salary deferral. That's what I'm going to do. I have a very high risk appetite that is not appropriate for everyone, so you have to sort of know yourself well, but prices could go much lower from where they are today, and so who knows, but I know that they are cheaper than they were a month ago, and so for me that's enough. But yeah, these guys are the experts here and are the ones that you should listen to for advice. So you guys can see the questions, right?
We can, yeah.
Yeah.
I'd like to.
Why don't you pick the ones that you like?
Yeah, I'd like to answer one of them. Anna asked, I have literally no knowledge of investing, and I just wanted everybody who's listening right now who doesn't have knowledge of investing, first off, to say that's okay. That's totally fine. For most of us watching this, there's probably some data and information that was shared that maybe felt like, man, that went over my head. I didn't really understand it. And again, that's okay. Here's the reality. You can get your investments done all on your own through a computer online. But one of the things that Jason said aligns with what Stewardship does, and that is, if maybe you're savvy enough or smart enough to click a few buttons online and do it yourself, you can. But even if you don't know, that's why we're here. We're wise advisors that are going to guide you through this process with wisdom and with love. And we're going to try to get to know your needs, to walk you through all of that and answer those questions as it pertains to investing. If you don't know how to invest, if you had some of this information that kind of went over your head, that's okay. And that's where you partner with a wise investment advisor like Jake, like Jeremy, and we can help. So that's the answer to that question. Did I miss anything there, Jake or Jeremy?
No, that's great.
Okay, cool. Jake, would you take the anonymous one?
Yeah, someone asked, what would you tell the investor that just rolled out of a 401k, so it's mostly in cash now? What is the best way to dollar cost average at this point with a larger starting point? So as Grant mentioned, personal finances is personal, so we may have to make a plan for you specifically. So going back to dollar cost averaging versus investing a lump sum, I mean, it all depends on your time horizon. So if you are a long-term investor, I'm assuming it is because it's a 401k, it still may be a great opportunity just to invest at all in the market now. Like Jason said, the market could go lower, but it's not really about trying to time the absolute bottom. It's about getting the money invested and getting investing in those companies. So I would say, yeah, if you're a long-term investor, it might be good just to put it back in. If it's going to be really hard, then we can make a plan to invest that over time.
Yeah, I would say it totally has to do with your risk tolerance. If you can't, if you can't really stomach the volatility, it's going to make sense to put it in over time. And it's going to get you invested that way, then do it that way. Again, performance is probably going to be similar either way. So whatever, again, is going to make you more comfortable during that time period, I would say do it that way.
Awesome. So Jason, there's a question on here that I'd love to get your response to. It has to do with somebody who just owns all Eventide's funds. Is that risky? Would you share a little bit of wisdom behind that? I mean, just for full disclosure, yes, Eventide is one of the mutual fund companies that we have access to, but there are several others, obviously, that as an independent advisor, we can help our clients get funds from many different places. But would you specifically answer that one, Jason?
Yeah, you know, and again, this is, you guys are going to get tired of hearing this. It is really dependent on your own personal risk appetite there. So we are on the level of the big name shops. We're a relatively small player. We have about a little more than 3 billion in assets. We have only 5 investments. You know, big mutual fund shops like BlackRock, they have hundreds of funds. And so your options are more limited with Eventide. One of the nice things about mutual funds in general is that the money is invested in companies, and you have daily liquidity, meaning you can sell out. And so it's not so much a risk of it's not so much a default risk on the part of one mutual fund company. It's just a limited range of options. And so, you know, you'll have to accept less diversification if you go with one mutual fund shop. For me, that's fine. I'm actually okay with that. I really, you know, as you would suspect, I'm a big believer in our approach. And so the limited options are something that I'm perfectly happy with, and I wouldn't invest any other way. But that's me, and I work at this company. So yeah, if you maybe you guys have other thoughts on that, but I would just say I don't think it's a huge default risk for a company, but you're going to have less diversification options for sure.
Yeah, I appreciate that transparency. And just as we said earlier too, it's like you can invest and be successful on your own, do it yourself online too, or you could use an advisor like us. You can have success in doing well and having lots of mutual funds with Eventide, but there's some wisdom probably in looking at other options as well. Just depends on that particular person, keeping personal finances personal. Jake, there was a question here from Michael Wright. Can we include some investing, or sorry, Jeremy, would you answer this one? Can we include some investing in a company that we're interested in? Would you answer that, please?
Yeah, so I think the way that we look at investing is we invest in mutual funds. The reason for that is that risk-adjusted return in mutual funds is actually higher than investing in individual companies. So we can let companies like Eventide find a lot of good companies that have the same values as us and all those types of things. But there's also going to be a lot of reduction of risk by investing in multiple companies. So you can always include a company that you really like in that, but we look at that as more as investing for speculation than investing for the long-term retirement type of account. So I think that's my thought there.
Maybe I'll just throw something out there. So just be careful, you know, when choosing individual companies. It's obviously something that whenever we find a company that we love, you know, it may make sense to do that. I'll give you an example. So we're using an interface called Zoom. The world has moved to Zoom during this time, and so, you know, you could think, oh wow, that's what a great investment. I should buy Zoom. The market's way ahead of you here. So Zoom has gotten very, very expensive as a stock, as people have appreciated how popular they are right now. And so sometimes our good ideas are a little bit late, and the you know, investing is about trying to anticipate where companies are headed, right? It's that famous quote from the hockey player Wayne Gretzky. You want to anticipate where the puck is going, not where it's at right now. And that's sort of a classic lesson in investing. But yeah, maybe you just have a company that you just absolutely believe in, and you don't care, and you love it for the long term. And so that may still be okay.
Yeah, I'd say the two of the most common questions that we're getting right now, especially on social media, people sending me direct messages or commenting on some of my posts are, hey, Grant, when's the bottom? When should I buy that? And what are companies you're buying in? I think both of those questions need to be adjusted, right? Based on all the information that we've shared here in this presentation. Trying to time the bottom isn't the wisest approach. And then also just picking one or two or three companies also isn't the wisest approach. The simple, steady approach is what's going to yield you the best results. We're going to answer two more questions. Jake's going to take those. We have one from Scott and one from Linda. Go ahead, Jake.
Yeah, so I'll take Linda's question. So she's asking, when retirement was 10 plus years out, I didn't care at all about the dips or the ups and downs, but now we're within a few years of retirement. Would you still feel good about investing extra due to the lowered prices? Yes, I'm glad you asked that, Linda, because a lot of this presentation showed very long-term time horizons, and not everyone has the 40 plus years of putting money in the market. So here's the encouragement. One, we make the investment portfolios tailored to when you are retiring. So there's probably a good chance, we're not 100% equity or stocks if we're close to retirement. But another encouragement I would give to those near retirement is the fact that, when you do retire, it's not like you just cash out all your investments, right? Let's say you're retiring at 65. There's a really good chance you have 30 years of retirement, and we do need to rely on stocks and investing in those companies to help not only give us income in retirement, but to build that and keep up and exceed inflation over time. So yeah, the 2 points there, it should be, your investment portfolio should be tailored to when you are retiring, but then also, we're still going to be invested throughout retirement. So last question, Jeremy. So I'll ask this from Scott. With so many people losing their jobs because of coronavirus and the impact on the economy, is there wisdom in either taking spare cash or pausing some investments to build up a bigger emergency fund rather than investing?
Yeah, so I would say there's absolutely wisdom there. Having a larger emergency fund in a time of economic uncertainty is great. You definitely should be doing that. And so having 6 months, again, it maybe even temporarily. Then if you're comfortable with 3 months going back there, that might be good for your personal situation. I don't know. But we recommend always between 3 and 6 months. In a time like this where there's a lot of uncertainty, I would say 6 months is healthy and wise.
That's kind of one of the things that is being brought to light as a result of this coronavirus situation, is those who are really struggling with their personal finances likely don't have an emergency fund. And those businesses too that are struggling with their finances likely don't have an emergency fund either. I love that question. I love that answer too. I'm surprised we didn't get any questions or comments on the Stewardship's coronavirus non-shaving beard action that us three have compared to the pictures that are.
Yeah, I thought about putting a poll in here, like who's concerned about when they're going to get their next haircut, right?
Man, Jason, we are just so grateful and thankful that we're able to have Eventide as an option for our clients. We are unbelievably grateful for the time that you put into this presentation. We're able to answer a lot of questions, bring some peace to people, and hopefully shift the mindset to a mindset that has a little bit more wisdom and love for people's investments as we move forward. Again, thank you so much for doing this, and to everybody who was able to attend and participate. We're grateful for your participation as well. Jake, Jeremy, and myself will be available for questions. Our emails are down there below. Be sure to follow and subscribe to the Defining Stewardship podcast. Jeremy has stepped it up to where we're basically publishing at least 2 episodes now a week, and we're doing anything we can to be very relevant to what's going on. So we're going to try answering questions proactively on that. Make sure you're subscribing to the blog. Jake has written some unbelievable blog articles that are really helpful to what's going on as well. And if you haven't yet subscribed to our YouTube channel, I'm posting videos there. So we got the podcast, the blog, and the YouTube channel that you can be subscribing to. And we're also going to be sending out an email with the recording of this so that you guys would have access to it. But then also an email that's going to have a link to what we're calling a market volatility page. That's going to share all of the podcasts, all of the blogs, and all the videos related to some of these topics. And that will allow you one simple place to access some of that. So did I miss anything, Jake, Jeremy, Jason, anything else you want to say in parting?
This has been great. Thanks for having me.
Yeah, it's been awesome. Thanks again. We appreciate your participation in this event, and hopefully we answered some of your questions. We look forward to talking and seeing some of you guys soon. Let's continue to pray for our nation and pray for wisdom as things roll out.
Yeah. All right.
Thanks.
Thank you.